Alright, so me and Bob have been through some analysis already, but I just started a video, so I will just go through all of what we've done before. This is a screenshot from the monthly chart which I always I already posted it in the channel. You guys saw it. We recently had this bearish leg down, which we rebalanced like above equilibrium. I believe it touched like the 62. Then we can also note this liquidity void on the monthly, which we haven't rebalanced yet. But that's I think this, yeah, you can see this is 2016, so this would take us pretty long to rebalance, right? We've also had this liquidity void, which was the reason for us to rebound off of this. Then this more recent bearish leg, we had a market structure shift, obviously, so this has been expansion. Then we got a retracement of the liquidity void on the monthly, which we saw already. We have the lowest candle, which is this one on the bull leg, which we have broken below. This is the mitigation block usually, so we've, as you can see, respected this 3 times already. 1 time with the wick and 2 times with the body already. And now we are running up again, looking to test it or whatever. Of this bear leg, we also have this equilibrium on the monthly, which is important because it lines up with the mitigation block. Above an OTE, and so this zone, I've marked it out, there's not much of importance. We have this FEG, which has been rebalanced once, so it's lost its significance. There's nothing really significant above equilibrium anymore, which is why I want to see this mitigation block hold pretty much. Yeah, and then we can continue because we've already went down to the weekly. So on the weekly time frame, you can see we have the equilibrium from the monthly noted here. There's this thick black line, and this small one, this is the mitigation block, which we've respected there. You can see it did not quite just touch it, just like we've seen it on this monthly screen, right? But barely. And then we have these highs, which you also saw on the monthly. So we've noted all this as expansion because we broke above again, obviously. And we took the OTE. This has been 4-hour OTE institutional order flow before, which we came back into this has-been analysis some time ago. So this weekly order block is of significant importance. As you can see, the body is got perfectly respected, and it shot up immediately. You can see this is obviously internal liquidity, so usually when you enter on internal liquidity, you want to exit on external liquidity, which would be this weekly high. The weekly high is important because it's also the 3, 6, and 12-month open float high. So it's the highest high in the last 3, 6, and 12 months. So this gives it more importance. And also it's the external liquidity, right? So then we have this bearish order block, which obviously got respected quite good as well. But price shoots up again. You can see and here's actually a fair value gap, but price violated it and didn't close below the consequent encouragement or the mean threshold of it, or the 0.5 equilibrium. And we have this FEG on the weekly, which retraced into last week. It was our perspective, 2 weeks ago, this week. It was our perspective, and now we shot down into it again, actually took out the low of last week, and now we are shooting up again, which is also important. Anything else? Right, no, not really. These highs, I wanted to write something down to it, but I basically said it, so that's of none importance anymore. We just keep going and delete everything which is unimportant for the lower time frame right now. So this is this. I'm gonna have this noted as well as this mitigation block, which is important on the week and the monthly, and the the equilibrium as well as the fib. I'll just anchor those. Equilibrium, the mitigation block, right. We are going to refine the weekly order block right now, so just one more thing. This is the 6-month open float below, and we've had a pretty decent, like, well, you could call it liquidity void. There are definitely going to be more FEGs than one inside this on the lower time frames. So liquidity void. This might also be of a significant importance, but we might also see it like unbalanced. We'll see. Yeah, and this is the 6-month open float low, equivalent to the 6-month open float high, which we have here. Yeah, let's drop down to the daily chart. Okay, so we have the weekly order block, obviously. So this time there's something important we gotta do. Okay, so the actual daily order block is this candle right here. You can see it. Why this is so, I'm gonna tell you. Wait. So for knowing this, we would have to use what I've learned last week. So the IPTA data ranges. I'm just explaining it to you. So you have like the last 3 months of view on price action. So this is the 3rd of July, the first day of the month. So of the closed months, the last 3, which is these 65 bars till here, this is the last 3 months. You want to look at the last 3 months and like what's the major structure. And if we like go back, you can see we've rallied up from here, but get down further, and then we shoot up again, and then we have this minor retracement, which doesn't matter for the purpose we have right now. But if you look at it, oh, that's not purpose. If you look at it, yeah, it's pretty obvious that this bear leg is the most significant one, which is also why I've noted this market structure shift to the downside. So if this is the most significant leg we've had and the most significant market structure shift in the last 3 closed months, we put a line on the 1st of that month as our anchor, and then do like the 20, 40, 60 day look back. If you look back 20 days, we had this low, which obviously got violated heavily throughout the first 20 days, and we have this 40-day extension. And if you look close, I put a green line on it. The green line for the extension is right next to this bearish candle, which is why we note this as the daily order block. And it has significant importance, as you can see, because we shoot up again. We have the 60-day look back. Only thing I really saw on the 60-day look back was like this side liquidity down here, which is the most significant one. In the last 60 days, why not the high? Obviously, this got taken out before our anchor, so this isn't relevant anymore, and also it's outside the 60-day look back. We're going to like look at the S&T divergence later, but you can see the 20-day forecast. It's pretty close to the low, which is basically the concept of the IPTA data ranges. And then you can see the 40-day being pretty close to this high, which is of significant importance. That's also why I anticipated price to drop below, because I wanted to see some change in market delivery. But it doesn't necessarily need to bounce like around just because it's another day extension. So it doesn't say that this must be bearish, but we've also had like a lot of things to rebalance. Like you can see on the weekly chart, we had the FEG, which we noted before. So we can reasonably expect some measure of like new high or low, whatever. Just some major market structure at a 60-day extension, which I noted here. So that's another, I don't know, what is it, 12? Yeah, it's 11 days. 11 days, yeah, 17 days with the weekends, but it's 11 trading days from now. Yeah. anything more of significant importance, we are going to note that on this chart because we have the order block, which we noted obviously. We have this high, which was of significant importance already. One more thing important was the weekly order block, which caused us to like break below. Let's see it here. This weekly order block right here. We're going to refine this as well. So the last up close candle before the down move, obviously this one. And then we can note this is the daily order block, bearish order block, minus order block, right? Also respected perfectly. And then I think we can go over to the institutional order flow, which is important. We are going to note this on the different chart. So institutional order flow fibs. We started the daily time frame, look back the last year, so 8th of July is today, which means we are going to anchor fib the 8th of July 2022. Stay December, November, October, September. Fuck. August. So yeah, so it's pretty obvious that this must be the lowest low. I'm just gonna note that. OTE daily, and then we go above and obviously put the high to the highest high we have in this time frame. Anchor the fib. Just note that it's the OTE is below price. Only thing important right here, but which isn't any surprise because we have had this massive rally down and then up in the last year. Let's continue with the 4 hour. 4 hour we do a 3 to 4 month look back. So 3 to 4 months. 1, 2, 3. We've had the 8th today, so the 8th of April is our anchor. June, May, no, April, 8th of April, which, yeah, obviously this is the highest high since back then and this is the lowest low. So OTE 4 hour, just like this. Note, we have had this like massive consolidation on the 4 hour time frame, which is like right in the OTE. This is of significant importance, but nothing to worry about yet. And then I'm going to take it one step further. Actually, we do that later. So just have these note. We have the OTE. We respected the 0.79 OTE with the order block we've had noted on the other chart. I'm just, yeah, this order block, right? Maybe one more significant like institutional floor fib is this one. So of the last rally up, we did not quite rebalance till the equilibrium, but we can also change it to like the bodies. ICT does some things like this, so you can see it basically rebalanced it. We're going to later look at the futures contract, but that's something else. Yeah, just note this as significant importance. So the rally up, basically we were at fair value and then shoot up significantly, which was against my expectation. But anyways, we had to change that and get a new view of the market for the weekend. So let's continue. Yeah. Nothing significant below here except maybe the order block, which yeah, this once was my expectation for the bullish run. I don't know how long this was ago, but I've noted this bullish order block before for price to scoop up here. Maybe some of you remember, some don't. Yeah, that's important, but I don't think that we will reach down to this anymore. But not in near time. Yeah, let's just get a little bit of water. All right. Continue. Yeah. This is high of significant importance, right? So basically, summarize everything right now a bit before we continue. Internet, please. No, my internet is like, yeah, it's pretty bad right now. We might need to wait a few minutes, but I can also like tell you on this chart. So expectation, I don't know. We have the mitigation block here, which I want to see respected. We also got like the respection like 3 times in a row, 3 months basically. But we haven't broken down to like any major structure. And usually when we see some order block or mitigation block, whatever tapped, you want to see immediate reaction to have like the institutional sponsorship on your side. So wait, yeah, we have the institutional order flow, we have the data ranges, we have the framework which we have done. Top-down analysis, we'll basically do that right now. The institutional sponsorship just spoke about it right now. Yeah, we have no real institutional sponsorship right here, which means we're basically, I don't know, the market makers aren't on the side of being bearish right now, I think. Just because of the monthly chart, of course, there's more, but yeah. Bond market analysis, the internal and external liquidity, and the open float. We just spoke about those two on the weekly time frame, I think. Maybe my internet is back. Hey, no, it isn't. But we spoke about those. You know, here's the internal liquidity. You can still see it. And this is external liquidity, obviously. So let's just take those off. Top-down analysis, gonna delete this now as well. We have spoken about the quarterly shifts. We can take those away. Weekly effects, the monthly effect. If the data ranges, institutional order flow. This, so 15-minute institutional order flow is still what we are missing. Also show you why price dropped and came above because of that. So yeah, we basically can't do much without a chart, please, internet. Nice. Really. I'm just gonna pause the video and continue as soon as my internet is back up. Alright guys, basically 45 minutes done. I just texted you, my internet shut off anyways. We could continue now since the charts are back on. And for now, we are going to leave the Eurusd and continue with the interest rate analysis. So bond market analysis, interest rate analysis is what we are going to do now. We need the 10-year bond and the 30-year bond, as well as the, I don't know if there is. Yep, okay, let's just barchart.com. We are looking for the 10-year note. Oh, I don't know where it is. Here it is, right? The 5-year note. Or is it? I don't want the... Let me just... Yeah. So we need the 5-year note, which is this for a chart. We need the where is it? We need the 10-year note. Nope, please don't. The 10-year note chart, please. The 5-year 10. And one last thing, we also need the 30-year. So why do we do this? Bond market analysis is, well, the interest rates and bond market is basically linked. So the interest rates are basically the single most influential driving force behind the market moves, which is why the analysis of the interest rates is highly important to us and can show us when there's just distribution in the interest rate market or when there's interest rate shifts. For this, we look at the 30, 10, and 5-year bond market. So basically, the 30-year is the key long-term interest rates, the 10 years the intermediate term, and the 5 years the short-term interest rate. So we are going to look over this in the recent, let's say, 6 months is fine. We can just leave it like this. I think maybe 9 months, no, 6 months. Let's take the 6 months. Okay, so we can see 5-year has been dropping significantly in the last period of time. Basically, all of the 6 months it has dropped. We have the 10-year bond market, which also dropped, equivalent to what we've seen here. And we have the 30-year. This has been kind of choppy here. Now we want to basically overlay. Let me just all 3 of these, because there's actually the same thing as the smart money divergence as in the bond market. So I think the most important thing here are these highs. You cannot quite see them on the 5-year bond market, but you can see that we've made equal highs. This has been significantly higher. And here, so when is this? When is this? This is the 24th. 24th? No. Oh my gosh. So 24th. This is basically, it's here. All right. So you can see we've had a drop, a heavy drop in the 30-year bond market after. We've also had a drop at the, so now where is it? So this, somewhere here. It's hard to see. Wow. So yeah, 10-year bond market. I think we can look here first. We've also had it. Well, it's a minor drop. You can see it. The most important thing here is that after this drop, we've continued to drop in the 30-year bond market, but we haven't done so on the 10-year bond market, which means there's basically a cracking correlation. We've also have like a rally here. Let me just look at the date. This is the 5th. Yeah, it's the same day. So we've had a rally above again on the 5 and the 10-year bond market, but not on the 30-year bond market, which is a cracking correlation, just like the SMT divergence, which means there must have been some measure of distribution in this phase. And if the bond market is bullish, we basically want the DXY to be, if the bond market is bearish, we want the DXY to be bullish, which means we go back to our charts again, trading view, delete this real quick. Oops, no, delete this. So this has been over the course of the last, what was it, 6 months, and it's daily time frame. Daily time frame. I think it might actually be the 24th has been here, and the 5th of the next month, 5th of April, is here. So this may take a bit, but the important thing is that we have this these lows here, which is a key thing for the a key thing on this chart on DXY. We're on DXY right now, which means that the cracking correlation on the bond market could have already told us that we would see this expansion on the DXY, which basically equals this bearish move on the dollar, Euro-US dollar. Yeah, so right now there's not really much, but that's just everything to the interest rate analysis. We may also take the 5-year note for a sec, so we can also analyze a bit of market structure on the... Oh, can you give me candlesticks? Yes, much better. So we can analyze a bit of the market structure on the... Okay, so this is a 5 now. Let's take the daily chart for now. I actually don't know how to zoom out on this. What the fuck? Like this. All right. Give me a second. Well, there's not much actually. We can see that we've been bearish overall, which means we should be bullish on the DXY in this case, which we also have been. You can see that the interest rate or the bond market kept dropping at this time, while the DXY start to come down again, right? Let me just get back to this. So yeah, basically we want to keep an eye on the bond market. There's not much interesting things right now which we could note for the DXY and therefore for the dollar, because, well, it's just dropping. We also aren't at any like significant point in the DXY. If we would be, we could analyze this more, but yeah, it's also more of a long-term analysis on the bond market. So then we can take the bond market off. And we can take the interest rate analysis off. Another thing we have is the low and high resistance liquidity runs. I have added those while my internet was gone actually. So let's just go back to this. I just thought about this today because it's actually, well, if you look at the monthly, we have this like sort of consolidation period right now. We're not really doing anything, no real drawn liquidity. Well, we've rejected the mitigation block, but there's nothing really, not much movement in this period of time. Well, at least not on the monthly chart. There is intraday, but not on the higher time frame. The problem with all of this is basically you can see where it starts. It's basically January of 2023, so basically the whole year. We know that there's been several wars and stuff, which also aren't good for the financial market. So this is actually a really hard period of time to trade in general. And this is not well, it's not a high probability market right now, which is hard because if we, well, it's 2023, and if you just like to learn trading in 2023, or for me, it's, when was it? I started here at this candle. So basically, the whole time I have been trading or learned to trade, that's the baddest situation of the last years to well, it's the unluckiest situation. It's not the baddest, obviously. It's a good time to like start and get into all this financial stuff and whatever, you know, escape the matrix and stuff. But this is actually a really hard period of time to be a trader and to learn trading, because you see these really hard conditions in which you learn to trade. But yeah, so times will get easier, but right now it's really hard. We may see like the break above this, the break above this, or a break below, maybe like the end of all of this, but right now it's really a hard period of time. And if you compare it to like the daily time frame years ago, there's so many like big liquidity voids all over the chart. Here, there, like there, and since 2023, like there's not much. Okay, so high resistance liquidity runs. There's a lot of price action in the way. No clear big series of like gapping candles, except for this. This was like the beginning of the year, right? So March, that's actually right around the time where the war kind of started. It chopped around. And right now it's, you get what I'm saying. It's not much. It's not high probability to trade in these situations, and it's hard to get an insight on what the market wants to do in these conditions prior to when the market actually does it. Like here, it was pretty obvious back then. Liquidity void, we came back into it. Drop below, liquidity void, we came back into it. Look, you get what I'm saying. But right now, it's really hard. And actually, another thing, we can get off the list. We might just continue with the smart money divergence now. I want to start on daily time frame, not below actually, and we will also like check off the 50-minute institutional order flow, and I may get to the time and price theory a bit before you do like this more economic stuff. That is actually something we don't want to do this. So smart money divergence, you know, or you should know what the smart money divergence is. It's the crack in the correlation between pairs. So there's smart money divergence between the Eurusd and the EU and the GU, or the EU and the DXY, or the GU and the DXY. It's just how they correlate. So obviously the Euro-US dollar and the DXY, which is the chart below here, the red and black, they are inversely correlated, while EU and GU are, well, yeah, they are as well. Bad example. I want to get some, which is, yeah, this is dxy, and this is, no, GU going up, EU not so much. So, and then we have the USD JPY and DXY. You can see the correlation here. It's basically, well, this is a big crack in the correlation between these two pairs recently, with USD JPY going up and the DXY does not, but that's something else. Don't want to finish now. So we want to concentrate on the correlation between the Eurusd and the DXY. Maybe you have seen the SMT I noted on the daily chart before. We have a bearish SMT here. Just to show you again, this is this. You can see it's moving similar, although it should not in general. And then let's continue actually to look for some more SMTs on the daily, which I may have missed, or which are recently showed. So I would be careful with like this, the minor differences. Or the larger the SMT, the better. But yeah. So we have this SMT. Yeah, SMT center top. Let's go further down the graph. We have this low, which there isn't really much. We have the high, which is similar. We drop below and drop the came above here, which indicates that we want a continuation of trend. Then we have this high, obviously, which has a lower high to the next of it, and here it has a higher low to the next of it, so also no crack in correlation. Then we have these lows and these highs, also no crack in correlation as far as I see. The only real problem right now is this high and this low. So you can see we broke below this low on the DXY, but we did not broke above on the Euro-USD chart, which normally would mean we are bearish. So this would be another bearish SMT, just like this one. This also is a bearish SMT, just that in this case it's a distribution on the DXY chart, and in this case it would be a manipulator or distribution on the Euro-USD. I'm not like set yet because this SMT is like really well, it's new, and well, we could still like break above this on the on Monday next week, but still it's a daily SMT and it's obvious, right? And we also have the daily order block, which is respected and all this stuff. So I will keep an eye on this, but I'm just not gonna short it right off the way on Monday. I'm really curious what happens, but yeah, this is something to note. So yeah, 4-hour time frame also. Let's just check, please. Internet, don't break down again. Oh wow. Okay, so I wanted to check a 4-hour SMT divergence somewhere in here, which I also sent in a screenshot during last week or the week before, I think. Yeah, again, internet is gone. Nice. To see if it was still valid or if this high broke it. I can't remember if it was like this or whatever. And after that, we will continue with the COT data and the market sentiment and the inflation and deflationary. But before we will finish the institutional order flow and all this stuff, but I think I will have to go downstairs again and fix the internet. I don't know what is going on here. Since the storm, I don't know. I will pause the video again. See you later. Alright, we are back again for our chart, like I just said, and we wanted to look for the SMT, which I noted last week being bearish on the Euro-US dollar. Just need to find it. It has been here, and we violated it. Okay, so for our SMT violated after we broke down below and actually cleared this low. The reaction was pretty massive. You can see that we did not had much price action below the low, which also indicates that we are bullish, just like the speed and the momentum did. One more thing to check with this. Yeah, this has been lower, just like this has been, obviously. One thing we can actually see here. This is minor, but still, yeah, you can see this, and this. Oh wait, it isn't actually. Never mind. It's hard to differentiate these, but yeah, this isn't. Okay. So, go back on the daily chart. We last had this bearish SMT here. We had a bearish SMT here on the 4 hour, which has been invalidated. Besides that, there's nothing on the daily or below. I'm not gonna look at the weekly or the monthly. Oh no, please don't do this to me. Oh wow. I guess we're doing this in 5-minute intervals now, when my internet works again. Anyways, I'm gonna spare you the time and just see when it's done again. Continue on the hourly time frame with SMTs and the institutional order flow. Yeah. Alright, and it's working again. We got a short pyramid of time. So let's just continue with the hourly chart. Right, so first institutional order flow. You remember we had the institutional order flow of the 4-hour chart before on the 3 to 4 months look back. The hourly chart has a 3 to 4 weeks look back, which means today's the 8th. 1, 2, 3. It's the 17th of last month, which means somewhere around here, whatever. Obviously the this is low, so the hourly institutional order flow, this blue one, is bearish. We are right now in the OTE, as you can see. We haven't yet disrespected the 0.79 level. On the 4-hour chart, you can see this imbalance, which the leg before respected. I don't think the current one currently did. No, so we disrespected the C of the FEG, which means this one's invalid, and we are likely to break the OTE actually, because I don't see any other. Well, maybe this rejection block. It doesn't matter. All right. Quickly continuing. We were on the hourly chart. So SMT divergences. I'm not going to look on anything below the hourly for today, at least not right now. Maybe if we are looking for some trade doing next week, but for now, I also don't think they're, well, oh, this is, you can see, this is actually, you can see the wick of the one candle going. It was close. This was close to being an SMT, but I'm not going to count this one. Otherwise, well, those are again equal lows here on the DXY and broke above. So this is also close. A lot of choppy price action. Yep. Don't see anything of importance here. So we are just going to continue with the 50-minute chart and the 50-minute institutional order flow, which is the last 3 days look back. So assuming today already is the next trading day, so Monday, this would be the 50-minute OTE with the 3 days look back. So obviously this day not much price action. We have a lower low at this day, which means this is the 50-minute institutional order flow. I'm looking at a higher time frame for some PD array around this level. I don't think we will come down to the 0.7 level if this fib is actually of some importance, hourly maybe. Yeah, we have the rejection on these wicks. Maybe this is a rejection block, but not of any significance. This order block might be important, which also means that this is a propulsion block, which we have seen rejection of, but still. Also 50-minute chart, we have this imbalance. Well, you could call it liquidity void and take those with you, which is pretty important. So important stuff below the current actual price. Big wick here, also important. We've rejected this once before, so I'm just going to delineate that so you can see. Yeah. Just like this. On the right side. Let's go back to our list, which means we have this done, we have this done. Time price theory. So I've teach this before to Bob when he was in the call. We can't really look at any live data, obviously, and it's also something, well, you remember the IPTA data ranges from before, which we know here. So this 60, 40, and 20-day look back, this is also time and price theory. What else is there? You have the things that are of importance is the, I'm just gonna do it on a different day. We have the kill zones, obviously, the blue shaded areas here, which are of importance. So London open kill zone, London close, and then New York open. Then you always, on each day on my chart, you see this blue thick line. This is the New York midnight open price. Often you can see that smart money is buying below. So obviously this was a buy day for the smart money. It bought here and then shot up. Sell the buff here on this day below, sell the buff below, bought below, went above. This was a choppy day. Sold above, went below, sold above, went below. Bought below, went above, bought below, went above. So you get the idea. So always having this delineated over the day is important. So again, everything I do is on the New York time frame, just like ICT. So everything ICT does on the New York time zone. So 0 GMT. only New York time. This is what you want to delineate, is New York midnight price. Other things of importance, like I just said, the kill zones, as well as the silver bullet hours, which means 3 to 4 AM. Then we have 10 to 11, and the least significant 14 to 15. I never trade this, but those are our 3 silver bullet times, so you want to have those kept in mind. Other than that, there's the 8:30 liquidity injection, which usually happens by news. There's probably a better example. Yeah, this is a liquidity injection, obviously. Then we have this 8:30 candle. We've actually had news at 8:15 that day, so that's something to keep in mind. This can shift. 10 o'clock, this was 10 o'clock news. But most times it's the 8:30. What else there is? 8:30. Then you have 7 and 5, which are of significant importance. So between 7, 5, and 8. So between 8 and 8:30, there's a news rally. Usually news embargo lift. It's the news embargo lift, right? It usually happens just before the news. Quick lift in price, or we go below, whatever. So just the volatility is coming back into the markets again after we consolidate from well, basically 5 AM. Usually when you have a good day, you can take a trade, and this is a good example. You can take a trade in the London open kill zone, which means this the first blue shaded area, you get it, and hold till 5 AM. So if you would have shorted right here at the rejection block, you would have exited at 5 AM. Just like here, basically 5 AM price starts to shoot up into the different direction. It's not always exactly 5 AM like you can see here, but roughly. Also here, London open kill zone, go below 5 AM, we shoot up again, just like we do here. Small consolidation, go up again. Yeah, here 5 AM is the high. We drop below, bit of consolidation before we start to get momentum again, with being closer to 8 AM. And then we've, yeah, again here roughly it's the high, it drops below, retraces. I could bet it's the OTE. What a wonder. Shoot up again. Again, yeah, you get the idea. I don't need to show to you like 500 times. Right. I don't know why. Well, yeah, the 5 AM thing. One more thing. Then there's, I think it was delineated on this day. So basically, let's go on a 5-minute chart for this. Whatever they take, let's just take any clean day. This was clean. So 90-minute intervals. I haven't watched a video to it yet in the core content because I didn't get so far yet, but I know it will be there at some time, and I have looked into those things yet. So every 90 minutes, starting with 0:30 New York time, if you draw a line, this is 5, so 6:30, and 8, surprisingly, 9:30, 11. So basically, ICT says every 90 minutes you could potentially get a new trade. So if you see this, starting with the day, you could have taken along here. Then starting with 2 AM, London kill zone open, you see this FAG trade up into this another 90-minute interval where we get into a small consolidation. New 90-minute interval, new trade. You can see we've been in this imbalance, the whole consolidation. bullish, take straight, right, for retracement in the next interval, again bullish. Then we have a reversal, again taking out this high with the new interval, shorting till this new 90-minute interval, going up again, next 90-minute interval, shorting, and then true day ends, basically. Just something to keep in mind, so every 90 minutes. Another thing we have which won't work on every day is the daily structure, which basically means you have what I need to get back into. So the daily structure. This will apply to 70% of the trading days. I just need to find it. So first you have a consolidation, which is basically the Asian range. Usually that's, well, for me that's this yellow box. This is the Asian range. You can see clear consolidation, a bit of before as well. Starting after midnight, you can see an expansion to the downside in this case. In this case, it's a Judas swing. So manipulation as well, expansion to the downside. Again, note it's below the midnight open line. Then you have a reversal. You can see this here. And another expansion into the New York session. After, you can see between, usually, between 5, well, in this case, not, wait. So, in this case, actually, the spike above, I'm sorry. This is the manipulation Judas swing. We have the run below, first expansion, retracement, or reversal. In this case, it's a retracement. Another expansion into 5 GMT. Consolidation till 7. Then after you have the rally, use embargo lift at 8. And at 8:30 the extra news comes in. In this case, it's another lift. After, you can see a run on liquidity. In this case, it's this huge imbalance most times. And have this, well, it's a reverse. It can also be a retracement, depends. After, you can see a clear consolidation again, ending true day. And then the next day starts. Again, you have this manipulation, Judas swing here, expansion, retracement, expansion. So this is actually the retracement. Expansion into 5 AM roughly, consolidation, news embargo lift, 8:30 news actually hits, reversal after we took out liquidity, consolidation for the rest of the day. You get it. So it doesn't apply to every day, but most of the time it does. There also are other daily structures which I haven't learned yet. So I don't implement those into my analysis. Inflationary, deflationary market, COT data, and market sentiment. So let's just get in the browser once again. COT data. Commitment of traders, right? So basically a report on if people are long or short. Actually, we could also, now we can take this. No, we can actually do this on no, where is it? I know it is somewhere on on TradingView as well. I don't know where it is here. So Euro COT data. This chart is actually pretty small. I know why it is. We might COT reports. I don't remember. No. Okay, probably on bar chart as well. Let's look for bar chart. Comment around traders, right? So let's view a chart. So no. I need to go down real quick. Wait. All right, I'm back. So again, looking at this winner of traders COT, there are roughly 400,000 people long and 590,000 people of the commercials short. This isn't important to us or of any significance. The non-commercials, there's way more people long than short, so it's roughly balanced. What is important, there's a lot of asset managers being long right now. And as we know, there's the market maker efficiency paradigm. So the smart money wants to take out large funds and retail orders, which means which basically the commitment of the COT data is representing. So if there's a lot of people long, you could anticipate smart money to be bearish, right? Another thing we may note here is, and which I haven't actually looked into recently, in the last few days. Let's take a new chart. Delete this. We need to actually delete this and open interest. Okay, open interest is basically, we can decollapse this. The open interest. No, not. Oh, don't. Hello, open interest, please. Yeah, so this is much better. So futures contract again. Need to just. Whew, finally. So the open interest data is basically the liquidity the smart money or the interbank offers. So the higher the interest, the more liquidity they have provided to buyers. So the higher the open interest, actually, the higher their interest is in pushing the market lower. You can, but this of course doesn't only work for one side. You can see in this case there was open interest building, well, basically staying at the same level as it has been before, while the market dropped. And then after, you can see that the open interest came down a lot while the market went above. Same thing you can basically see here. significance in this is when you have a change in the rapid change in the open interest. Like in this case, it was above 15%, so that's of significance important to us. And also here, 25%. This can be an indication of smart money to changing their well, to just either get a lot of buy positions or get a lot of sell positions, or that they don't want to be in sell positions anymore. So in this case, open interest sank rapidly, and after price scooped up. If you look at this, it came up a lot, and I don't think this was 15%, so this wasn't as significant, just 9%, right? But still, after price rallied a lot after the open interest scooped up. But that's also more of a long-term analysis, and also in certain, under certain criteria, like for example this 15% rally or decline. So yeah, we're just going to delete this. Wait. And get my kill zones back onto charts. Now I need to recalibrate them. So, the range. Yeah, right. We can take this off. Yeah, and so last part is inflationary or deflationary. So listening to the FOMC reports, we've had a heavy increase in the inflation rates and the interest rates. We have had a pause of increasing the interest rates, not last, but the meeting prior, I think. So the last meeting we had a pause. So we are expecting the interest rates and the inflation to rise again. Well, the inflation rise, but as next step we want interest rates to be raised again, which should fight the inflation again. But currently I don't know why inflation is at 4.9%. Okay, so if we look at this chart, the inflation has been declining, deflationary, obviously, but we need to this. You can see this isn't as. I would have liked some more recent data, but anyways, deflationary interest rates are increasing. We are deflationary. So nothing more on our list. Basically, have all of this done. Looking back at what we have analyzed now. So monthly chart. It's a bit of a mess, but if you remember, we are at a mitigation block. And basically pretty undecisive right now. And it all basically comes up to what happens in the next few days. Also, if we look, let me check one last thing. So like last 20, yeah. So the proportion block, no, I don't think it was here, but somewhere with a proportion block was of importance, right? Here. lower time frame. This propulsion block is of importance, and actually what happens with this. So if we only retrace on Monday and opening on Sunday, only retrace into this and scoop up again, it's actually relatively probable that we scoop up and take out the weekly high, which was also, yeah, we scoop up and take out this high. We might also scoop up and take this weekly high, but as I said before, the conditions right now are hard. We will probably, so Forex Factory news for next week. Monday, nothing. Tuesday doesn't really impact us. Doesn't matter. Wednesday we have CPI, MM, and YY and Core MM. This will be important to us. 8:30, so we probably will trade the long open kill zone. We don't really care about this. Another day, Thursday, again 8:30 news, so probably don't trade New York session, but the long open. 6:45, well, it's just water, doesn't matter. Also pretty late in the day. French bank holiday, we talked about it, don't really care. And the Perlum. Okay, so this might actually be a day where we can also trade the... So that's Monday, trade both sessions. Tuesday, both sessions. Wednesday, London. Thursday, London. Friday, both sessions. Probably, but just need to get an early access on the New York trade. Going back to charts. So we either could reasonably expect it to rally up actually, because we've had these, what we talked about before, we have the weekly order, we have the weekly imbalance, which we really felt came up rapidly, obviously. Took out some lows, also, well, got immediate rejection to the upside and not much price action below with the daily order block, which didn't really cause any, well, market structure shift or anything like that. So this one, it's tiny. Not any major change in market structure of the daily order block still. So probably disrespect this one. This could have been the first retest, and now we disrespect it with coming into next week. And next target would probably be this high, which obviously is of significant importance. Weekly high, 3-6-12 month open flow, that external liquidity of our internal liquidity entry on the weekly order block or the daily order block in this case. So yeah, let's look at the weekly again. So I don't know, it's really messy. We could still just scoop above the daily high and still well, we could still respect the mitigation block on the monthly. We may also not. We still have this monthly order block, which we came down. Also, no real change in market structure whatsoever. So pretty bullish structure on the weekly actually. Although yes, I was bearish because of the IPTA data range analysis, which was true at first, but it's hard. I thought this was the high, but obviously Friday showed it has not had much impact. So this could also be the 60-day extension, could also be some high, like we talked about in the 11 days, right? It's hard to say, but I think I'm shifting more into bullish, at least above this high again on the weekly time frame, because I don't think the mitigation block actually holds as much power on the monthly. As you can see there, well, for it to be of any significance, we would have needed some more change to downside, more pressure to downside, so that there's no buying and selling pressure in the market, but just for my poor vocabulary in English, I want to see price to I would have wanted to see price to go down further for this to have an impact, right? So there was no real impact by this mitigation block on a monthly time frame. I probably would be bullish, but whatever happens on Sunday, and whether if we retrace or if we completely go below, and how Monday opens pretty much defines if I will still be bullish, but I'm leaning towards the bullish. Yeah, I hope the video was insightful. If you have any questions, well, we will talk later. I will try to upload this as soon as possible into the Google Drive.